As investors, we have a regular temptation to make quick trading profits, but we do not want to take huge risk. We will explore in this video how we can use the relatively safe mutual fund strategy to trade and make profits without the risk of a typical stock trading. We will use a live calculator, and I am choosing the example of HDFC FlexiCap Fund. Not because it is a top performer or anything, but because it's one of the oldest funds, has history. In fact, some of the other FlexiCap funds would have performed much better. And if you use that for this calculation, you will find the trading profits much more alluring. But that was not the objective of this video. It was not to excite you. So please listen to the full video to understand the downside as well as the chances of an upside of profit. The idea is from the age-old NSE certificates of the post office, but more on that later. In this example, I am considering an investment of a monthly rupees 30,000. In case you cannot invest 30,000 every month, you could consider 10,000 or a 5,000 or an amount that you're comfortable with. And to know how the system has performed in the past, I'm assuming for this example that you started investing 10 years back and you invested 30,000 as your chosen amount every month through a SIP. And you do this for 5 years without a break. At the end of 5 years, you come and look at the units that you purchased in the very first month. Here, the NAV has grown from 447 to 667, an increase of 49%. And rupees 30,000 invested is now rupees 44,800, a profit of 14,800. You take this profit out and you reinvest the original capital, which means your further SIP is being funded by your old investment itself. No new money is required. In other words, you need not sell all the units, just book the profit, allowing the remaining units to remain in the fund, and this keeps growing and compounding. That is more tax efficient way. Now, let us analyze the trading profits made, that is percentage. It is 49% in this case, about 15,000 from 6th year onwards. Every month you start taking the profits, and as you go down, you will see that in some months there are no profits. You pass this month, and then sometimes the profits are more than what you had even invested. That is 100% or more. Sometimes it is 70%, sometimes it is 80%. As the bull market rages and the bear markets arrive, the amount varies. This should give you a broad indication. In fact, this is at the peak valuation. The profits are as high as 200%, which means on 30,000 rupees invested, your profits are 66,000. A few insights into this strategy. This is not about frequent trading, but a systematic approach to profit taking after a 5-year investment horizon. While the returns may vary, you could initially start taking monthly profits from the 6th year onwards. However, returns won't be uniform. Some months may yield more, some other months may yield lesser, depending on the market condition. During the bear markets, there may be months with no profits at all. It is important to stay patient, allowing your investments to recover after a while, and you focus on the long-term growth potential. By only booking the profits and reinvesting or not touching the original capital, you benefit from a more tax-efficient strategy. So selling fewer units keeps the remaining amount invested and growing. This minimizes the tax liability. This approach ensures you're not just trading, but allowing your core investment to compound while extracting regular profits. It offers a balance between taking some short-term gains and continuing to grow your wealth over the very long term. There are many variations to this strategy that you can try. For example, you can extend the time frame beyond 5 years to maximize long-term growth, or you can even shorten it to 3 years if you're looking for quicker returns. The key is to adjust the time frame based on your financial goals and risk tolerance, while keeping the balance between taking the profits and letting your investments compound. If you're an investor who cannot frequently monitor your portfolio or the markets, and wants to avoid high-risk volatile stock trading yet want to book profits regularly, this could be a clean, efficient way for quick gains. However, quick gains often come with higher volatility and potential losses. Back in the day when NSE was offering 12% interest, agents used to say, stay invested for a few years, your money will double, then you can take out the profits and reinvest the rest, which is the original amount. This way, you don't need to reinvest any new money. You just keep reinvesting the original amount and you enjoy the profits every month after a 5-year hold. If NSE gave 12% then, there are chances that your mutual funds may deliver 12 to 14% CAGR on your investments. This means you can double your investments in about 5 years. By the time you're selling, what you bought in the first year has already doubled, which means you're sitting on 100% return. Now, instead of just taking all the money out, this plan can ensure your returns keep working for you, creating kind of a perpetual return machine. What you can do is to take 50% of profits yourself and reinvest the other 50%. The amount you reinvest continues to grow at the same 14% CAGR. Essentially, your investment starts generating its own reinvestment capital without you needing to put in any extra money. This system is built on 6 foundation principles of investing guided by legendary investors for long-term discipline, for staying invested during market volatility, for the benefits of compound interest, for managing risk, for avoiding market timing, and the power of consistency. If you like this video, you may also like to look at this one or this one. Please consider sharing this video with your friends, liking it, and subscribing to this channel.